Good morning, good morning. Just starting my stream, waiting for my YouTube stream to come up. I do believe I'm live now, so we'll go ahead and get started. Again, this is Ken Creager from Black Swan Financial Advisors and the community at Possibilities Achieved. I just want to remind everybody to, share the information about the community, join the community. It's supports families with family members with special needs, and it's just a resource and an open community that's not restricted by geographical boundaries or diagnosis or anything like that. So please join if you're one of those people that want to help people with special needs. Maybe you have family members or you know somebody, a friend or whatever. Encourage them to join as well. So anyway, again, reminder that all my videos are for educational purposes only, and that's it, only for educational purposes. So this video is technically part one, even though I did the teaser video about options. So this is the first official video in my little mini video series that I'm going to be doing, and then I'm going to be doing a course, a course a little bit. It's going to be more advanced options, more on hands, more detail, more examples, and give you an opportunity. That's going to be a premium service, but it's not going to be very expensive, and you can look forward to that, and that will give you a lot more information about how you might include options trading in your tool belt, and how you might be able to use stock options. So anyway, the course, A Beginner's Guide to Investing, Hedging, and Managing Risk with Options. And this is the course outline. We did the teaser. We are on part one, cracking the code, understanding the ins and outs of stock options. Basically, we'll talk about what are options, and then we'll get into pricing and time to decay, understanding the basics, option strategies for beginners, covered calls, protected puts, and then a little bit more detail into what we introduce in part three video, and then we'll do risk management with options and a guide to hedging your portfolio. And then options trading, mistakes to avoid. Okay. Remember, options are leverage, and so if you make a mistake, it's a leveraged mistake. So anyway, keep that in mind, and we'll just get right into this. So cracking the code. What are stock options? So I'm going to go into a little bit of a definition. You'll hear about a thing called a call option and a put option. So there's basically two kinds of options, calls and puts. There's a thing called a strike price. Options are a contract, and they have an expiration date. Okay, it's very important. So with options, not only do you have to get the price right or the direction of price movement, but you need to get the timing correct, because you can't. When it expires, it expires. And if you bought a call option and it expired at the end of the month, and on the first day of the next month that stock jumps up really big, well, you lost all your money because your option expired before that happened. Using options to invest, using options to manage risk, and what are the potential rewards? So what are stock options? It's interesting. They have been around for quite a while, and they're a financial contract. And they were actually designed to help money managers, to help people hedge or protect their investments. It's a risk management. It's kind of like insurance, at least the way that they were originally designed. Nowadays, options are used really for speculation a lot, and because with a little bit of money you can control a lot of stocks. And but when you do speculation, that's more like going to Vegas and playing, or playing the lottery or whatever. So anyway, it's a financial contract which gives the holder the right, but not the obligation, to buy or sell a specific stock at a predetermined price, known as the strike price, within a specific period. Again, that time, that expiration time. So options can be bought and sold. So this is really a huge point. There's a buyer and a seller of these puts and calls, okay? And if you're a buyer, usually that's more speculative kind of thing. If you're a seller, your purpose is a lot different for selling the option to the buyer. So you can buy or you can sell. So there's call options, talked about that, which is the right to buy the underlying stock, and a put option is the right to sell the underlying stock. And it's a financial contract. I mentioned before that it uses leverage, and it covers, or it controls 100 shares, okay? 100 shares of that stock. One contract controls 100 shares. So if you have that's really, really important, because if you have $100 stock, then one contract does not control $100 worth of shares. It controls 100 times 100, which is 10,000. Okay, so you need to be really, really careful when you're doing stuff. Okay, so call options and put options. And then also for a call option, you have buyers and sellers, and for put options, you have buyers and sellers. So the call option itself is the right to purchase. The put option is the right to sell the underlying stock for which the stock option contract is for. But options are contracts, right? They're their own entity. They're not part of the stock or anything. They're their own entity, and that contract has buyers and sellers, okay? So again, call option, the right to buy; put option, the right to sell. All options have a buyer and a seller, and you can be either one. So this is a really interesting point right here. And one of the main reasons around one of the strategies that I like to use, which the teaser kind of went into, which is buying stock at a discount. Basically using an option to get into a stock position that you want to get into anyway at a discount. And that's because 75 to 85% of all stock options expire worthless. So if you're the buyer of a call option or a put option and it expires worthless, you lost all your money. If you're a seller and you sold that option to the buyer and it expires worthless, you keep all the money. Okay? So being a seller leverages the fact that 75 to 85% of all options expire worthless. And most options get bought for speculation. Okay, so based on those statistics, do you want to be a buyer or a seller? Sometimes it makes sense to be a buyer, but most of the time I'm a seller of options, because sellers win more often than buyers. Okay, so let's go on. Now I'm going to show you a little bit about what this looks like in this happens to be, I think this is on Yahoo. All the interfaces look very similar. So when you look at a stock, usually there's a tab or something you can click on and you can find the options. You'll hear it referred to as an options chain. Okay, so up here, this is the price. It happens to be at 10:51 a.m. and the market is open. And right now Microsoft is down. It's $278.87. So here's the calls, here's the puts, and this is the expiration date. Very important. And this is the strike price. So remember, this is a contract. So it's interesting because there's a contract for you to buy, for a call, which is the right to buy, or a put that's the right to sell Microsoft for 150 bucks. Now, if, for example, we'll use this one. I bought this call. It's going to expire on March 31st, which is the end of this week. And the current price is $278. Okay. Let's do that. We're just going to use round numbers. And the strike price is 150. So if you bought that call, okay, you could buy that. You could buy that for 150. So 150, it's $128. That's how much intrinsic value kind of, well, it has some time value, but you see how close that is, 128 to 131 bucks. So if you bought this right now, you'd have to pay $130.95 for this call that would give you the right to sell it for 150. I mean, buy it. Sorry, buy it for 150. Calls are the right to buy. Now, if this jumps up to 300 bucks, right, and you have a right to buy it at 150, then that would be great, right? So you pay 131, and you have a right to buy it for 150. So that means your net cost would be 281 basically. And if it went to 300, you would be sitting on some profit. Okay. So these are the strike prices, and for very liquid stocks, there's a ton of strike prices and a ton of dates. There's weekly stock options for most of the very liquid ones. So you'll notice right here the change in color. That's because this is the strike prices closest to the current price. Okay. And this is where the biggest premium usually is. Okay. So let's talk about this one here. $277.50. So that's the right for you to buy it for $277.50, which would mean you're, $1.37 profit if you had that call. But you're going to have to pay $5.10 for it. Okay. So this is kind of showing you can kind of see the market is thinking that Microsoft's probably going to go up by the 31st because these call options are pretty expensive. Now, this is the right to sell. Now, say, for example, you owned Microsoft and maybe you bought it at 200 and it's run all the way up to 277 and you're kind of worried that it might go down. Or maybe they're going to do an earnings announcement tomorrow and maybe you'll spend a few dollars and get some insurance. So basically you say, well, if I paid 200, it's 278. Well, if I get a put option, which is the right to sell it for 275, so that would basically lock in $75 per share profit. I have to pay $2.20 per share. So this price is not the price of the option. That's the price per share for the option. So one option contract controls 100 shares. So if you bought this put, you would pay $220 for one contract. Okay? But, that's pretty good. It's $2.20 per share to protect your $75 gain. Okay? And if you bought that option today and tomorrow earnings came out and this stock went down to $225, you would have the right to sell it for $275. Okay, so that's one way you can hedge. We'll talk about that in another video. So again, the strike price is the fixed price at which the underlying stock can be bought or sold through the options contract. Options contract controls 100 shares per 100 shares. Okay. Expiration date is when the contract will become invalid. Okay, it will expire and you no longer have the right to anything. It'll just disappear, go away. So time decay, options decay over time. And that's one of the reasons most of them expire worthless. Because you have to be right not only in the direction of the price movement, but you have to be right in your timing. So again, if you go back over to this one, the shorter the time, the higher the premium percentage, right? But if you went out 30 days, okay, these prices will be more, okay, because you're 30 days out, and as you get closer and closer, the time will decay. It drops off really fast. And when you sell options, actually, this is what you're relying on. An option that's about 30 days out, 30 to 60 days, is kind of the optimal, where you get some time to be right. The premiums are still pretty high, okay, because the time value goes off really steeply, okay. So using options to invest, again, you'll have to tune in and look for my advanced options course, and we'll really get into all this stuff. But one of the ways is, like I said in the teaser, was, well, I want to get into a stock anyway, and I want to get in for a discount. So I can sell a put so that I can end up buying the stock, okay, at a discount. So example, I want to buy 100 shares of Microsoft. Remember, you got to deal in lots of 100. Okay, if you get a contract, it's 100 shares. So maybe I have $27,000 and I want to invest it into Microsoft. So I go over here and I buy this, I sell this put at $280 and I get $4. Okay, so on Friday, if the price is $280 or lower, the person that bought this put from me will give me those stocks, and I'll have to pay $280. But he gave me $4 up front, so I end up paying a $276. So almost $3, a $3 discount for less than a week. Okay, so that's if I want to buy. Selling a call option on a stock you already own. So maybe I already own Microsoft. I own those 100 shares, okay? Well, it's interesting because I can sell this same call, this 280 call, and somebody's going to give me $3.69. And what'll happen on Friday, if it's over 280, my shares, the 100 shares that I have, will get called away. The person that bought this call will buy them from me for $2.80. So I will make, $1.13 plus the $3.69 that they already gave me. Okay, so I'll make, almost $5 a share, right? And so that's one way you can generate income. For example, is you have stocks that you already own and they're sitting in your account, and as the stocks go up, or even if they're just going flat, you just sell calls. They're called covered calls, and you sell them to get some money. That will reduce your cost basis. So let's talk a little bit about maybe using options to to protect you or to manage risk. And this is one of the few times that personally I would buy an option. Okay, and I've done this before, and sometimes it works out and sometimes it doesn't. But the bottom line is maybe you're sitting on a significant profit, and maybe the economy is getting kind of shaky like it is right now, or maybe you own Microsoft and earnings are coming up and you're kind of concerned. It's had a big run up and you want to protect your gains or whatever. So one of the things you could do is you could buy a put option, which is the right to sell, and that's the example that we used just a minute ago. I buy that put option for $275, so if Microsoft crashes, I could sell it for $275. But I had to pay $275. I had to pay $2.20 for it, right? So another way is, this is how I usually do it. I don't usually buy put options on individual positions. If I had some that were, up hundreds of percent, and I knew there was a particular, an announcement or something like that that might cause extreme movement in the stock price, I might do that. But mostly, I kind of hedge my portfolio because, to me, anyway, my long stock positions kind of goes with the market going up, right? And I'm concerned that the market might go down. Like last year, I actually used some put options to my advantage last year, where the market was down 25% or so, and I had used some put options to make some money as the market went down, and it offset my losses on as my portfolio was going down. So say, for example, you have a $100,000 portfolio invested in stocks and they're up pretty good, they're up 50% or 100%. And so the S&P, there are S&P related ETFs that have options on them. So you could go find one, or maybe you're mostly invested in tech stocks. So you might use a NASDAQ related ETF and go buy a put option on the ETF. So that would kind of hedge your whole portfolio. But it's insurance, basically. That's what you're doing. It only works when you need it, so it will only work. And you can use it to offset losses, though. And there are some strategies that you can use that are not super expensive. You spend a little bit of your profit to maybe protect, larger gains. Okay. Last point. Okay. Again, this video is for educational purposes only. Okay. Risks and potential rewards. Okay. I'm going to say this several times. Most options expire worthless. And so if you're a seller of the options, either you're selling puts to get into a stock that you want to get into anyway, or you sell covered calls on something that you already own and get some money, most options expire worthless. And so usually the sellers are winners much more than the buyers. Okay. And I don't recommend using options for speculation, which is the meme crowd. And I mean, that's how some of those guys were making lots of money really quickly and losing lots of money really quickly, is they would buy a call option on AMC or whatever, and the price would move. And remember, options are leverage. They control 100 shares of the underlying stock. And so if there's a big price movement, say let's go back to Microsoft. Say Microsoft doubled to $500, say almost $500. And you own this call option that you paid $3.69 for 100 shares. That's $369. But if it jumps to 400, 500, that's $220. So you would be sitting on $220 per share. So that's 220 times 100. Okay, actually you'd be sitting on 220 plus $3.69 times 100. And you could turn around and this option will be worth that much, $220 more than it is right now. And you can sell the option, or if you own this shares, right? So options allow you the ability to control shares of stocks and companies without actually owning the shares, okay? And it's leverage, but leverage works both ways. Leverage can bite you on the bum. So anyway, thanks for joining me. Educational purposes only. Ken Creager from Black Swan Financial Advisors. Please pass the word. Join my community, the community at Possibilities Achieved.